Hi, I am Anna. I come from www.ntvforex.com. Asia Open Risk Rides on Market Reaction to FOMC Analysis. http ntvforex.com News ID 183F6A 7/29/2021 AM. Today's outcome is huge for risk, as there's no disguising the fact that a lot is riding on the market reaction to the FOMC when it comes to setting the general tone for the market over the rest of the summer. And it's possibly the biggest curtain raiser to the most critical Q4 for stock markets ever. US equities were weaker Tuesday, the S&P down 0.6% as earnings reports fared mostly worse than expected. Notably, the consumer side is lagging, as the CV19 factor can be best viewed through the lens of the iconic McDonald's. They reported a more substantial than expected decline in profit, reflecting fewer sales and rising virus-related average costs to safeguard employees. Trust me, after growing up in Canada and spending the early stages of my trading career in New York, when folks are not lining up for their McMuffins or Big Macs, it's the most definite signpost that the recovery is wobbling. Forget the Big Mac inflation index, this is the Big Mac CV19 fear index coming to the fore. Supporting that view, even Starbucks reported its first quarterly loss in 7 years. US 10Y yields fell back to their recent lows, off 4 bps to 0.58%, which put a bit under gold markets. Indeed, the consumer outlook is not shaping up much better in Q3, but this really should not come as much of a surprise, with CV19 wreaking havoc across the US Sun Belt states. The stock market is exhibiting worrying symptoms of distress as US lawmakers haggle over the CV19 aid recovery plan, which is a vital lifeline for millions of jobless Americans, as CV19 continues to wreak havoc on the US economy and disrupting people's lives. This disruption, likely brought on by consumers' fear of the virus, is starting to show up in the economic data and earnings reports. Currency markets. The USD is enjoying a brief respite from the constant selling seen during July. While the faltering gold rally offering one excuse for the pause, when trying to pin the tail on the currency donkey these days, causality is seldom clear. Signs of a plateauing in the US COVID-19 case count, if sustained, could help temper US growth concerns, while steps taken towards securing an additional US fiscal stimulus could aid the dollar's cause. But ultimately, if the Fed holds the door on dollar weakness, currency traders will more than oblige them, as there'll be a stampede to the entrance, with currency traders selling the dollar given the nascent signs of US cyclical economic weakness in July, even more so as there's an early signal that EU economic stabilization is showing up in the data and will give more than ample cause to sell the buck. Gold markets. Gold surged to new highs but eased in volatile trading on the back of a firmer USD as traders look to FOMC and possible consolidation for either bond yields to melt or gold to temporarily flutter, depending on the Fed dovish ambitions. Gold jumped in Asian trading as chain retail demand swarmed the Shanghai futures pit en masse, with the yellow metal listing new highs of $2,000 ounce on the December futures contract and $1,980 ounce for spot. The surge to these levels proved fleeting, however, and the bullion market soon pulled back, possibly due to the absentee correlation to yields. But I suspect all golden eyes will be trained on the China Retail Open to see if gold thunder does strike twice. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.